Hi students, good afternoon. This is CS Srinivasrao Nakka. So we are here today to review the question paper CMA final SFM December 2025 attempt. Just now we got the paper. So the overall opinion of this particular paper is moderate. MCQs also 6 to 7 MCQs students can answer easily, and remaining 6 MCQs, 6 to 7 MCQs a little bit difficult. With the classroom knowledge they have to answer the MCQs. Okay, let us see the MCQs first. You know very well 30 marks MCQ is deciding paper for your SFM. So first MCQ from investment decisions. Of course, students can do this MCQ with the classroom knowledge. They know what is profitable index, formula for profitable index. Based on that, they can calculate easily, but a little bit time taking. So first MCQ easily they can answer. 2 marks they can get. Happily they can get how many marks? 2 marks this MCQ. And next second MCQ. Of course, this is also from risk analysis of investment decisions, and they can do the sensitivity factor. This is also very simple, 2 marks. With classroom knowledge they can answer this. And next one, certainty equivalent coefficient. This is also again from risk analysis of investment decisions, and they can do that also. 2 marks they can get easily. So 3 MCQs from investment decisions, means advanced investment decisions or as well as risk analysis of investment decisions, very easy questions. And this is a direct MCQ, but it is not there in your CMA institute material or MCQ booklet. But however, based on the theory, if you are reading the theory of debt securitization, you can answer this MCQ. So this may be, I can say, moderate. I am not saying it is a easy MCQ, but the students which are not reading the question then may not answer this. Okay, next, 100-day stochastic analysis. Actually this is a financial analysis, risk analysis. Students may not read this one. This is a difficult. Students may not read this one. That's why it is a difficult actually. So it is a difficult. Why I am saying it is a difficult? Maybe students are not reading this MCQ. Okay, so next, this is Aran Limited as a 1 million bonds outstanding, valuation of bonds. With the classroom knowledge they can do. This is a easy MCQ. Okay, so out of this around first, second and third and as well as sixth MCQs are easy. 4 MCQs, 4 into 2, 8 marks they can get. And next one, this is also from your portfolio management classroom knowledge. You can happily answer this. This is also easy, 2 marks. Okay, next this one is equity shares buyback of. So leveraged beta, maybe students may not answer because they are not reading that levered beta, unlevered beta and all. So this may be a little bit moderate. If students who are reading that concept also, maybe it is also easy. Okay, and next one, credit risk. So this is not a direct MCQ from your institute material, so it is a difficult one. It is a difficult one because this MCQ is not there, and we are not expecting the students to read this MCQ. Means the entire theory in a CMA institute material and can answer the MCQ. It is not possible. Okay, this one is difficult. Okay, and this one is okay with their classroom knowledge. Happily with the option. Okay, strategies, option strategies are there. So with that option strategies, happily they can solve these option strategies. And next one, this is also not a direct MCQ and a little bit difficult only. So students has to read the entire theory concepts of institute material, then only they can answer. So this is also difficult only. And this is okay. This is from IFM, International Financial Management. So they can happily answer. And actual lectures, this is from IFM. It's a very easy MCQ with the classroom knowledge they can answer. And interest rate parity theory, yes, this is also this is a direct MCQ actually. So you can answer normally easily. And which one are the following examples of cryptocurrencies? This is also easily with digital finance they can answer. So around 10 MCQs are easy. So 10 into 2, 20 marks you can get comfortably in this. Maybe another 5 MCQs are difficult. Maybe you are not expecting the students to answer those 5 MCQs. So I can say 20 marks, 18 to 20 marks students can get in MCQs. 18 to 20 marks. Okay, least case students may get 16 marks in MCQ paper. Okay, least case with their classroom knowledge. Okay, they can get 16 marks. So this time what is the finding? MCQs, they are not asking direct MCQs from institute material or maybe the MCQ booklet given by the institute. That is the only change actually. So earlier up to the last attempt, what trend they are following? They are giving the MCQs directly. Majority of the MCQs, 7 to 8 MCQs, they are giving direct MCQs from the CMA institute material or MCQ booklet. But now they are just asking the MCQs based on the conceptual knowledge of the students. The 1 or 2 MCQs only direct MCQs. Other than that, there is no direct MCQs this time. Okay. Anyhow, even though there is no direct MCQ, still it is easy. Now come to the descriptive paper. Descriptive paper. This is from replacement decisions. As usually, this is a cost-based replacement without any life disparity. But only one point is added, government subsidy. That is a normal point only. You know the treatment of subsidy if received cash inflow, capital receipt. That's all. Okay. So first year only they are receiving government subsidy. This is the only point they added. Other than that, I'm almost this model has been covered in our classroom discussion also, and any other material also. This model will be there. Only one point is added. So this is not a very difficult problem. This is a simple problem, replacement, but time taking they have to do by adjusting the time. Next, this is actually lease financing. Of course, the same problem is there in our material also, computer system. So as it is the same problem almost they are giving. So this is a very easy question, lease financing. This they can comfortably they can answer this question for 7 marks. Okay. Next, this one is from sensitivity or risk analysis of investment decisions. They are asking that coefficient of variation. Okay. They are just making an attempt to confuse the students, but it is very easy. If you are reading the problem, it is very easy. Just they are giving the benchmark separately. So calculate the benchmark. After that, calculate the actual correlation coefficient of the projects, and it is very simple problem, and you can complete within 3 to 4 minutes also. Very simple coefficient of variation. This type of problem is not directly 100% is not covered in our classroom discussions, but coefficient of variation is calculated, and the benchmark, this is the only extra point they added. Not that much difficult. By reading the problem, students can understand, can solve. So this is also, I can say, it is 7 marks easy. Okay. Next, valuation of bonds, actually they are asking based upon the growth rate or both based upon the dividend discount model. You have to calculate the valuation of share value, and so you have to calculate the valuation of share as per the market price is given. Market price is 550, and what as per your calculation what is the market price, and you have to decide whether it is undervalued or overvalued. Very simple problem. So this is, I think, very simple. Only thing is multiple growth rate. That's all. This multiple growth rate model is already covered in our classroom discussion. Multiple growth rate is there. 12% is the first year growth rate, and second year 10%. Third year you have to calculate G is equal to BR formula. Very simple. Already G is equal to BR formula is also covered in our discussion. So just they are making an attempt to confuse the students, but these are basic concepts of valuation of shares only. Okay, multiple growth model. And this one is 4A, again valuation of bonds and shares chapter only. But only thing is volatility of the bond they are asking. That is the only new point. Okay, duration of the bond, volatility of the bond. Other than these 2 points, this point is very easy to calculate the value of the bond. Okay, you have a yield to maturity 15% is there, and you have a coupon rate, you have a redemption value, you have a face value. So happily you can calculate the value of the bond. And if it is reduced by 100 basis points also, again you can calculate the value of the bond, and 75 basis points also. But only thing is duration of the bond, volatility of the bond, these 2 points only may be little bit difficult to the student. So out of 7 you will get 4 marks comfortably for other options. Okay, that's all. Next, this is a mutual funds, of course, valuation of calculation of NAV, net asset value. Beginning of the 1st April 2023 how to calculate NPV, and 31st March 2025 also have to calculate the NPV, then NAV, sorry, net asset value. And dividend also you are receiving maybe 3 rupees per unit dividend is receiving. So you know holding period return formula, you have to calculate holding period return formula. Dividend received plus NAV 1 minus NAV 0 divided by NAV 0 into 100. By using that formula you can calculate the rate of return for the 2 years holding period. Okay, that is what, very simple. You can calculate NAV as on 31st March 2025. It's very simple. Net asset value of the fund as a valuation date, that is also simple. And valuation date as on 31st March 2025 also you can calculate. Okay, next, returns are 2 portfolios. This is from portfolio management, and they are just asking expected rate of return under CAPM, and alpha they are asking alpha. So and based on the alpha you can see which portfolio is effectively managed or not. So very simple problem, 7 marks you can get, students. And next they are asking mutual fund. Of course this is a Sharp, Trainers and Johnson's alpha. This type of model is already covered in our classroom discussion, and even material also it is there. So 100%, the 100% same problem has been asked in the examination. It's very easy, students can do this problem. And 6A is of course from derivatives and portfolio management combination. So how to reduce the portfolio risk, how many number of features you have to purchase, okay, to reduce the risk of portfolio beta. So like that there is a formula, and this type of same problem is already asked 2 attempts back. The same problem is asked and discussed with the students also. This is also very easy problem. If student only one small point they are asking with missing figure they are giving. Okay, and after that they are calculating beta of the BZ. So they are giving beta of portfolio and they are asking beta of BZ. This is a missing figure. Just one small point is added. This type of model is also covered. Comprehensive points they are adding. Okay, next, so 7A actually from international financial management. So this is only arbitrage with cross rates. Okay, how to calculate the cross rates, and you should identify is there any arbitrage opportunity exists. There is a direct rate is there and cross rate is there. Calculate the cross rate and compare with the direct rates, and maybe you can arbitrage through cross rates. This is a very simple concept, but I don't know why this has been asked for 7 marks. Okay, next. This one is of course advanced model of your IFM, like hedging through options, hedging through money market, and hedging through forward contracts also. Which option is better? This type of model, one or two problems already we discussed. Okay, same model they asked, but only thing is we discussed hedging through forward contracts and hedging through options as a different problem, and hedging through money market as a different problem, but they are asking three types of hedging in one single problem. Maybe it is time taking. Okay, and so you have to be select carefully how to select. Okay, whether we have to attempt this question number 7 or not. And of course theories as usual, as expected, digital finance one question, discrete one question, and the rest of the theory concepts they are asking one question. This question maybe if you have a knowledge, general knowledge, you can answer, otherwise students may not answer this question. So overall the MCQs maybe you will get 16 to 18 marks or 16 to 20 marks. And portfolio management chapter is very easy. Valuation of bonds also a little bit. Lease financing and advanced investment decisions, risk analysis investment decisions. Almost what are all the chapters? Category A chapters. Okay. Risk analysis and valuation of bonds and shares, mutual funds, portfolio management, derivatives. So if you are prepared thoroughly about all these category A chapters, what we discussed day before examination strategy, then definitely you will get above 60 marks in your SFM. This is a moderate paper, I can say. Sometimes I can say it is an easy paper also. Easily you can score above 40 to 50 marks. So there is no concept of failure in SFM subject for this attempt actually. Okay. Right. Thank you. So all the best for your next exam.